Hey Vancouver, this is your February 2022 Greater Vancouver Housing Market Update. Stick around because we're going to talk about the Bank of Canada and new construction sales at the end. What I want to emphasize right now is that the situation is changing rather quickly. A war has erupted in Ukraine, commodity prices are ripping, adding to the inflationary pressures that are already there, and the Bank of Canada has begun raising interest rates. To suggest it's been a busy few weeks would be an understatement. So all of this is to say that real estate data works on a lag. The housing market is beginning to turn, and that will not show up in the data for perhaps another month or two. So what am I saying? What am I seeing? What are we seeing on the ground? Well, buyer activity is beginning to slow. On the ground, we're seeing fewer offers. Instead of 8 or 9 offers on a house, which was typical maybe 4 weeks ago, now we're seeing 2, 3 offers and sometimes no offers. Pricing strategy is beginning to shift. The days of grossly underpricing a home for bidding wars is becoming a risky strategy. For example, homes worth homes that are worth $1.8 million but listed for 1.5, that might only get bid up to 1.7, which then prompts the seller to reject all the offers and then relist the house at 1.8, the price they actually want. At the end of the day, none of this should be surprising. We had back-to-back years of record home sales and insane price growth. Nothing lasts forever. Buyers are exhausted, and the macro backdrop is shifting from euphoria to concern. We've got Ukraine and Russia. We've got record prices at the pumps and rising food prices. Eventually, rubber meets the road and you hit a price ceiling. Since the start of the pandemic, the price of a typical house in Greater Vancouver has increased $592,600. That's nearly $300,000 a year. It's important to note that we are still in a seller's market. Inventory is still incredibly tight. However, anecdotally, it appears the market has peaked and we are turning a corner. We're now entering the busy spring market, which typically brings a lot of new listings. I believe it's quite likely this will allow inventory to build and alleviate the pressure on the housing market. Sellers are still in the driver's seat, but that is changing. This is a subtle reminder that this shift in the market sentiment will not show up in the data right away. In fact, the home price index is likely to point higher in the coming months because it does work on a lag. However, the best time to sell your house was in January and early February during the blow-off top. So let's get into the condo market and look at Vancouver condos. They are moving higher. And just to clarify my views when it's to say that the housing market has likely peaked, I'm largely talking about the pandemic winners. Houses and townhomes, particularly in the suburbs, are starting to slow. That's not the case for condos in the city. While the housing markets tend to move in unison across the world, that's largely based on the global liquidity provided by central banks. Housing is still hyper-local. In other words, it's very possible that we'll see price decline in suburban houses while all at the same time seeing an increase in condos downtown, for example. Let's look at the condo inventory. Right now, Vancouver condo inventory dropped 20% year over year in February as sales increased 8%, The best way to look at this is the sales to active ratio, which has now climbed to 47% in February and is on its way to make its usual highs in the spring. Now let's look at townhomes. In the suburbs, townhomes in the suburbs, which appear to be going in the opposite direction, they are slowing into the spring market. Yes, townhomes in the suburbs are going from red hot to just hot. So more importantly, it's this change in direction that matters. Townhome prices in the suburbs have nearly doubled in 2 years, while condo prices in Vancouver are still trading at their peak 2018 levels. So ask yourself, which one has a stronger likelihood of price declines as the pandemic comes to an end and a good portion of the labor force heads back to the office? My feeling is it's going to be the townhomes. Brace yourselves. We do have liftoff at last. The Bank of Canada has officially raised interest rates just by a mere 25 basis points. This was the first move since 2018, and it comes at a time when inflation is running at 30-year highs. The markets believe another 5 to 7 rate hikes are still coming this year, and some are calling this the Paul Volcker moment. So in case you forgot, Paul Volcker was the head of the US Federal Reserve in the 1980s, and the last time inflation was running this high. Volcker raised interest rates from 11% to 21% in order to squash inflation, which undoubtedly caused a lot of pain. Things got so bad that the home builders started mailing 2x4 lumber in the mail to Volcker as part of a protest, claiming that their lumber was no longer needed because nobody was buying houses. So is this our Volcker moment? I think some much needed context is in order here. Back in the 1980s, Canada's household debt to GDP sat at roughly 40%. Today, it's well over 100% of GDP. In other words, it's not going to take very much to severely tighten the financial conditions. Per David Doyle at Macro Research, when you account for private sector debt levels in Canada, assuming we get a total of 6 rate hikes this year, 25 basis points each time, this will equate to the largest tightening cycle since the 1980s. In other words, our Paul Volcker moment will be from bringing rates from 0 to 1.5. Let that sink in. These are rather precarious times. Not only are we saddled with debt, but we have inflation running at 30-year highs, and the central bank is going to try and tame inflation by raising debt service payments at a time when commodity prices are poised to surge even higher. Rising fuel prices, rising food prices, and rising debt payments is not bullish for the Canadian consumer. This is going to be a painful squeeze for households, it's going to be a painful squeeze, and households are going to be forced to pare back on their spending. This will ultimately feed through into housing. We already are seeing activity begin to cool in parts of the country. Per Hedgeye research, there have been 12 recessions since 1946. 8 have followed major oil price shocks, and while a further 3 have occurred immediately following a more modest but still notable oil price run-ups. So while the resale market is remaining extremely competitive, buyers are looking for opportunities in the new construction market. I personally sent quite a few clients the pre-sale route in order to avoid the intense bidding wars percolating in both the resale townhome and condo markets. If you can find pre-sales that are priced well and with low deposit structures, they can be quite lucrative. Don't get me wrong. Unfortunately, they're becoming increasingly hard to find as developers they've been ratcheting up prices to account for the strength in the market and the rising construction costs. Yes, don't forget those rising construction costs. Per Urban Analytics, it was a record year in new home sales. In 2021, we set a record for sales for new units, surpassing the previous high set in 2016 by over 30%, or by 30% rather. The primary difference between 2021 and 2016 was where the sales occurred. In 2016, just 22% of new multifamily home sales were recorded in the suburban markets south of the Fraser, where 2021, these areas accounted for more than 43% of all new multifamily home sales. Sales have been particularly strong in the suburban submarkets of Langley, Surrey, and South Surrey, where townhomes and low-rise condos have been in high demand. So while there's been a boom in the valley and most of the lower mainland, we're still seeing weakness for pre-sales in downtown Vancouver. The high-end luxury market remains sluggish. This should not really be a surprise, considering new high-rise condos in downtown Vancouver are averaging north of $2,000 a square foot, and the offshore buyers have not participated in this cycle like they did in the 2016 one. So that's my market update for you in February. We're looking at February 2022 in review. My name is Josh Kepke at McDonald Realty. Give me a call, text, or email if you have any questions. I would love to get the conversation going. You can put those questions in the comment. You can DM me. You can call me or email me. Feel free to reach out. And hey, if you like this video and you want to see more like it, you can subscribe to the channel. We also have great home tours and pro tip series for you. So that's it for now. Thanks for watching. See you next time.